from earlier this afternoon talking about the Federal Reserve and the monetary policy. There is surging waves of inflation that are coming. This is kind of the idea that is hitting the mainstream media right now. And what it is that we need to understand about the monetary policy that then gives us a better understanding of how it is that we deal with our personal situation, because everybody's economy is unique to themselves. Now, when I think about the monetary policy of the Federal Reserve, I think about it in two fashions. One of them is the traditional way that most people understand the Federal Reserve. They lower interest rates to try and stimulate the economy. They raise interest rates to fight inflation, try to slow the economy down. This is very typical, very textbook 101 understanding of the Federal Reserve and how it is that they conduct monetary policy. Now, there's another way of also looking at the Federal Reserve and their monetary policy to get a better understanding of how it is that they conduct themselves when it comes to easing or tightening of financial conditions. Now, over the years, like many years now, 20 plus years, I have gone through many documents of the Federal Reserve trying to figure out what it is exactly that's taken place with monetary policy so that I could have a better understanding for myself. And when I started breaking this stuff down, I realized that there is two communications that are taking place out there. And to understand what it is to have these two communications is what is taking place with monetary policy. And again, this is very confusing, but I'm going to help you out with it. First, I want to break down a little bit of this speech. Not even break it down. I just want to talk a little bit about it. This is coming from Philip Jefferson, February 21st, 2025. So it's like a year old, right? It's not even that old. And this is what it says, because he's talking about communicating about monetary policy. This speech is titled Reading Between the Lines, Textual Analysis of Central Bank Communications. Okay, in this speech, super important to understand. Using textual analysis and high-frequency asset price data, the high-frequency central bank communication data, this research shows that investors' reactions to specific sentences communicated by the central bank are quickly incorporated into asset prices. Now, bang, think about this. What happened today with Jerome Powell in the delivery of the words that he used, right? Specific words and specific sentences communicated by the central bank are quickly incorporated into asset prices. Think about what it is that's being pushed out there. How many people are all of a sudden going, oh no, the inflation of the future, right? The future inflation, the surging waves of inflation. What is this going to do? This raises inflation expectations. Now, somebody says, what's the difference between expectations and the inflation itself? Like, why do we look at it in two different ways? Here's a reason. Let's just take, for an example, hypothetical situation. You're an investor. You're going to get 2% interest on your investment. Somebody says, hey, I have an investment for you for 2%, but I'm also going to tell you there might be inflation coming. That's 3%. If you're an investor who thinks that there's 3%, because somebody says, hey, man, there's a 3% inflation coming, and you believed them, and then somebody comes to you and says, here's a 2% interest rate investment, would you take that as an investor because you have this expectation of 3%? No, of course not. You're going to demand a higher return because you have an inflation expectation that is elevated. That means every decision that you make today based on your elevated inflation expectation has a real outcome, as if there was elevated inflation. Same thing, right? Because you have to make a decision based on that expectation. If it's going to be inflationary in the future, I better make the decision today as if that inflation has already occurred, even if it hasn't occurred yet. This is why there is a difference. There's actual inflation, and then there's inflation expectation, which is a self-fulfilling prophecy. That is very important to understand because it's that manipulation that has taken place right now. Again, specific sentences communicated by the central bank are quickly incorporated into asset prices. If you think that there's elevated inflation coming, how much are you going to pay for that bond? quickly incorporated into asset prices. You see what's happening here, guys? You see how it is that the central bank's communication are quickly incorporated into asset prices. This is real time. This is happening today, right? That's why I waited for today to then share this information with you yet again, how it is that it's taken place. People say, give examples of it. Here it is. This is exactly the example that people are asking for. How is it that their communications are quickly incorporated into asset prices? If you believe that there is going to be inflation going into the future and it's going to be elevated, how much are you willing to pay for that bond? Quickly incorporated into asset prices based on the communication of Jerome Powell. You see? All right. Goes on to say this: communications are likely to affect the course of short-term interest rates. That bond price. The bond goes down, the bond goes up, the yield goes down, the yield goes up. If the bond price drops because the investor believes there's an inflationary scenario coming into the future and he says, I want a higher return from my investment, that bond price will have to go down. This is quickly incorporated into asset prices, the short-term interest rate. You see how this is working? It's not difficult. It does take some concentration, does take some understanding. Once you see it, it's clear as day. It's clear as day, right? But it's difficult to initially see it because most people are stuck on some other belief system. Once you have internalized what it is that the monetary policy is trying to communicate and what that communication does to asset prices and short-term interest rates based on those communications, everything starts to line up, right? Think about all that communication that's being done out there and what that's doing to investors' expectations, how that is quickly incorporated into these asset prices, right? And it goes on to say this. I'm going to go back and read it. The effective communications are likely to affect the course of short-term interest rates, other asset prices, gold, silver, real estate, stocks, bonds, right? And associated economic outlook, right? How it is that people are going to feel and behave going into the future based on this idea of what's going on within the economy. This is resulting in an easing or tightening of financial conditions. This is the scariest part for most people to then internalize. If you raise this inflation expectation, you will raise that neutral interest rate. Remember, it's all about communications. How those communications are quickly incorporated into asset prices. Think about what Powell said today. If you are an investor anticipating inflation coming into the future, how much are you going to pay for that bond? Right? Because those communications are quickly incorporated into that asset price. This is going to determine the interest rates, right? Again, the short-term interest rates associated with those bonds based on the investor's expectation of the future, and resulting in an easing or tightening of financial conditions. This raises or lowers the neutral interest rate and moves ever closer or further away from the Fed funds rate. If you have ever increasing amounts of inflation expectation, it will raise the neutral interest rate. Elevated inflation expectation raises the neutral interest rate. That raising of the neutral interest rate moves ever closer to the Fed funds rate and makes the economy less restricted. This is a huge benefit for the rich. This is exactly the game plan that the Federal Reserve has attempted to deploy since 2020. This speech was given last year. Do you not think that they are using this technique today? I mean, here it is, Philip Jefferson, one of the members of the FOMC, voting member of the FOMC, literally gave a speech describing exactly what it is that they are going to do to increase or decrease the asset prices, which is essentially the bond, that then has that short-term interest rate associated with it. This is how they are conducting monetary policy. Not the interest rate adjustment. That part, not the big deal. What is the big deal? Your expectations. and how it is that people are hung up on every single word that the central bank uses, because those words are deployed for a particular purpose, right? Specific sentences communicated by the central bank are quickly incorporated into asset prices. Think about that happening today. This is real-time example of this speech. How many other people know it? None. Nobody knows it except for the central bankers and 56 people here on the Uneducated Economist. We're the only ones. Right? And then maybe a handful of other people once this video gets uploaded, since the YouTube algorithm doesn't want to spread it around for anybody else to enjoy. So I'm so glad that 60 people have decided to come into this live stream, understand, get this information so that they can internalize it for themselves and hit that like button while they're doing it. All right. So isn't this a foregone conclusion? All right, hyperinflation is 50% MOM increase. We're nowhere near that. Right, right. So isn't this a foregone conclusion? What are we talking about? The surging waves of inflation? Well, for us, it's like we already understand it, but most people have no idea on what this really means, on how this idea of elevated inflation expectation, like regardless of the inflation part of things, like that's a real painful experience. I totally get it. Everybody knows it. We can communicate and talk about how painful of an experience it is and then regurgitate that information over and over again, or we could try to understand how it is that this is benefiting the monetary policy and ultimately the asset holders who are the consumer of this in this economy now. Like once we get that part, then like the whole pain and suffering part of it is like, yeah, that's a terrible experience. We totally get it. We're facing that. We can continue to talk about it, or we can figure out what it is that we need to do about this situation that the Federal Reserve is using for their benefit. This is not a mistake. That's another thing. This surging waves of inflation is not a mistake. This is monetary policy, right? And again, if we go back and we look to monetary policy strategies for a low neutral interest rate world, John Williams straight up said it. Like, I mean, he straight up said it back in 2018. Today, we face an altogether different set of problems stemming from a very low neutral rate. That is the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is a risk of inflation that is persistently too low rather than too high. That saying, they would rather have the inflation too high. Persistently too high inflation. This is something that I've said over and over and over on this channel. The Federal Reserve wants to be high, getting high and staying high, whatever it takes to be high. They love being high. Once you're high, you never want to come down. I don't know how many times I've said it and how many different ways of saying it, and here it is taking place. Nobody else wanted to say it. Everybody else says, oh, the Fed's going to zero. Yeah, and I'm like, the hell they are. They're going to do a few symbolic rate cuts, and then that's it. You're never going to see them move that much ever again. They might do some adjustments to continue with the credible threat that they will adjust rates. But as long as they can move that neutral interest rate based on the inflation expectations, why would they move rates around? They have a monetary policy tool. What do we got? Oh, you want to show? All right. I'm glad Freddie cut me off. I was getting a little too intense there. So Freddie pulled these out of the computer? Is that where you got these?
Yeah, I cut open a bunch of computers.
So he wanted to show these off, these little copper coils that he was able to find out of there. And so since copper's going up in price, he got real excited when he found those. He also found a bunch of what?
Lithium.
Lithium? Oh, the lithium batteries, yeah. And then ROM, right? You found a bunch of ROM.
A bunch of what?
Then what else did you find? RAM? What did you find?
Yeah, RAM.
RAM, right? The RAM shortage that's out there.
Yeah.
So, anyway. Cool. Your parts and pieces, man. Thank you for sharing.
Yeah.
You're cool, kid. I love Freddie. He's such a good kid. God, he's such a good kid. Yeah, he had a couple of old computers and stuff that we've had for like years, and he asked if he could take them apart. And I'm like, Yeah, I guess, if you want to take them apart, sure. And man, he disassembled them and took like every piece he could find apart. And he was like, yeah, finding all the hard drive and everything else. All right. How long can inflation expectations work in the long run until they have no change in their strategy? Well, it's a matter of keeping the supply chain broken, right? See, this is another thing. Understanding like how it is that inflation is actually being found in this economy is not from the ever increasing amounts of money expansion as much as people want to believe that, right? That is a way of creating an inflationary scenario, but for the most part, the United States is not doing a very good job of creating an inflationary scenario with the printing of money. Right? I get it. Everybody's going to push back against it, but they can say whatever they want. Quantitative easing 1, 2, 3, and 4 failed to produce an inflationary scenario that the Federal Reserve was looking for. That's the whole point of this credible threat theory, is that they could not make inflation take place even after expanding the balance sheet by 4 times, right? They took an $850 billion balance sheet to over $4.5 trillion, and it failed. It failed to produce an inflationary scenario. This is why this speech exists. Again, this is monetary policy strategies for a low neutral interest rate world given November of 2018. Right? And ironically, the problem they needed to solve was a risk of inflation that was persistently too low. This was after all that quantitative easing. I don't know how many people understand what it was that the Federal Reserve was facing, but the money printer went broke. It didn't work at all. None. It couldn't find inflation. All right. And so, as we understand what it is that the Federal Reserve was truly facing back in 2018-19, when COVID kicked in and the supply chain broke down and the stimulus checks were handed out, everybody focused in on the money printer. And I was one of the few people who said, this is more about a supply chain breakdown. And if you follow lumber, you're going to see it as a perfect example. And that's exactly what happened. Lumber was in huge shortages prior to COVID. 2019, there was mill curtailments and inventory depletion for miles, right? I mean, from Canada to the southern part of the United States, there was depletion of inventory all across the United States when it came to lumber. And I'm talking 2019. COVID kicked in, stimulus checks were handed out, mills were shut down, and inventory was zapped, gone. None to be had. You had people moving out of the city, moving out to the country, signing contracts to have a house built. That's inelastic demand. Lumber prices shot right through the damn roof. And I was out there saying, don't fall for the money printer go burr, causes lumber prices to go up. This is an inventory shortage. Once these mills fire up and start producing more lumber, you're going to see the lumber prices drop, and that's exactly what happened. Like, it could not have been any more accurate than that. The only way I would have been able to call that out is by understanding the Federal Reserve was begging, hoping, pleading, and praying for an inflationary scenario to take place. And as the finger was pointed at lumber, I said, don't fall for it. Don't fall for it. Lumber's in massive depletion right now. There is a huge shortage taking place. Do not blame this on the money printer. And everybody was just like, dude, you don't know anything about the Federal Reserve or lumber. And then what did we see? Lumber prices came down to a normal price, and everybody had no way of explaining it except for the uneducated economist. And now I don't mean to brag that up or act cocky about it, but if it wasn't for the understanding of the monetary policy at the time, I never would have been able to do that. Never in a million years would I have been able to call it out like that. Yeah. All righty. As the fiat scam makes your dollars worth even less. Well, as long as so long as you believe it, then the power is given to the Federal Reserve. Right? I mean, we can talk about how it is that the dollars lose value every single day, how painful of an experience that is. We can talk about that, and then we can understand what it is that does for the rich elitist people out there, because what that does is it raises the neutral interest rate. It gets ever closer to the Fed funds rate, and it makes this economy far less restricted than anybody would have given it any kind of consideration for. We can continue to talk about the painful experience, the devaluing dollar, the money printer go burr, the blah, 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 and the Fed stuff, right? Or we can understand what that does, that mindset does for the neutral interest rate, which is actually a benefit to the wealthy. So as they deploy the inflationary scenario into your mindset, they're winning the game. Does anybody else see it that way but me? I mean, this is how the Federal Reserve described it. I'm trying to share it in a working class point of view that is breaking this down from 20 years of research and 50 different speeches that I had to come up with in order to develop this credible threat theory. But they are using the elevated inflation expectations of the people as a weapon against them to raise their wealth. Can I say it any simpler than that? Right? I don't know how many other people can see it that way, but I'm trying to share how this is being done. And most people say, dude, if you don't see how the inflationary scenario is created by the money printer, then we just can't listen to you anymore. And I'm thinking, there it goes. There's the Federal Reserve's power delivered, wrapped up in a cute little bow, and literally, here you go, Jerome. We, the people, deliver you everything you have ever wanted. We believe in your inflationary scenario. All right, so I guess the money printer is the proverbial gold machine. That's right. That is so right, Deja. Let's bring up the money printer go burst scenario for real. Where does the money printer come from? Right? This hypothetical gold machine. Right? A little parable may prove useful. Today, 1 ounce of gold sells for $300 more or less. Think about how old this story is. This is the Federal Reserve from 2002. Long time ago. Federal Reserve 2002. This is how the Federal Reserve says that's okay. When you guys hit the lower bound of zero, when the central bankers get to the lower bound of zero and there's no more downward adjustment to interest rates, we got a plan for you. He had this plan years, 4 or 5 years before the Federal Reserve actually got to the lower bound of zero. They had a plan already in place. Here it is. Let me tell you about the plan. They got to tell a little story first in order for you to understand how the plan's going to work. But it goes like this. A little parable may prove useful. Today, 1 ounce of gold sells for $300 more or less. Now suppose that a modern alchemist solves his subject's oldest problem by finding a way to produce unlimited amounts of new gold at essentially no cost. This is a hypothetical story, but let's suppose some scientist out there says, hey man, I know how to make gold and I can make gold cheap, right? I know how to do it. Moreover, his invention is widely publicized and scientifically verified. This is the important part. Widely publicized. Widely publicized means everybody knows about it, right? If this invention is widely publicized and scientifically verified, that means everybody believes it. They are for sure. This guy can do it. Scientifically verified, widely publicized. That belief system is solidified, right? All right. Widely publicized and okay. God, I already lost my place. Okay, here we go. And he announces his intentions to begin massive production of gold within days. What happens to the price of gold? So here it is. This guy, widely publicized, scientifically verified, proven that he can do this, and it has now been announced he is going to fire up the gold machine. What happens to the price of gold? Right? Presumably, the potentially unlimited supply of cheap gold would cause the market price of gold to plummet. Even, right? Indeed, if the market has gold is to any degree efficient, the price of gold would collapse immediately after the announcement of the invention, before the alchemists had produced and marketed a single ounce of the yellow metal. What has this got to do with monetary policy? Like gold, US dollars have value only to the extent that they are strictly limited in supply. But the US government has the technology called a printing press. This is Bernanke telling people that they are going to fire up the printing press. And think about what he meant by this gold machine. Here it is, a gold machine to produce unlimited amounts of gold at presumably no cost. What would happen to the price of gold? It would plummet. Okay, but the US government has the technology called a printing press, or today its electronic equivalent, that allows it to produce as many dollars as it wishes at essentially no cost. What is Bernanke leading to here? By increasing the number of US dollars in circulation, or even by credibly threatening to do so. Where do you think I came up with the credible threat theory? By credibly threatening to do so, the U.S. government can also reduce the value of dollars in terms of goods and services, which is equivalent to raising the prices in dollars of those goods and services. We conclude that under a paper money system, a determined government can always generate higher spending and hence positive inflation. You hear what he said? This presumably the unlimited supply would cause the inflationary scenario. They don't have to do anything with it. They just have to convince people that they are. This is the monetary policy. Elevated inflation expectations based on what it is that's coming into the future elevates that neutral interest rate, and it moves it ever closer to the Fed funds rate. This is how the Federal Reserve is conducting their monetary policy, because they knew they were going to run into the lower bound of zero. Goes on to say this. Of course, the U.S. government is not going to print money and distribute it willy-nilly, although, as we see later, there is a practical policy that approximates this behavior. Normally, money is injected in the economy through asset purchases by the Federal Reserve. What is he talking about here? Asset purchases? To stimulate aggregate spending, when short-term interest rates have reached zero, the Fed must expand the scale of asset purchases or possibly expand the menu of assets it buys. It means buying a whole bunch of treasuries and maybe mortgage-backed securities. All right? Here was the plan 5 years before it was executed. Anybody else want to think about what it means for monetary policy to have inflation and inflation expectations when you hit the lower bound of zero? For example, by making low interest loans to banks and corporate with the, the Fed must expand the scale of asset purchases or possibly expand the menu of assets it buys. Alternatively, the Fed could find other ways to inject money into the system, for example, by making low interest loans to banks or cooperating with the fiscal authorities, with the government itself, yeah? Each method adds money. That means they go into mass stimulus packages, spending, and stuff like that. Each method of adding money to the economy has advantages and drawbacks, both technical and economic. One important concern in practice is that calibrating the economic effects of non-standard means of injecting money may be difficult given our relative lack of experience with such policies. This is where it broke down, because they were not expecting the flattening of the Phillips curve. And this is really where the understanding of why it is that they conduct themselves the way they do today is so important. Because the flattening of the Phillips curves is when the Fed has lowered interest rates and the unemployment is falling lower and lower and lower, but the inflationary scenario is not manifesting from it. That was the flattening of the Phillips curve towards the end of 2018, and it was one of the reasons why the Federal Reserve was scared that their monetary policy was no longer going to work without an inflationary scenario. Right? This is where they were hoping for their opportunistic reflation and develop something called the makeup strategy, where they're going to let inflation run extra hot, extra long for an extended period of time. Wow, we got 46 people watching, 69 people watching with 46 likes, 47 likes. Thank you for continuing to hit that like button. Big money printer this year, 100% QE 1, 2, 3, and 4. Least we forget. They told us they can't lie. Unbelievable. All right. How do we get asset class to let go of some of the assets? What can we trade to take advantage of this? How do we get what they need to trade for it? First of all, they're not going to let go of their assets, so don't think that there is a way that you can do that. What you have to do is become an asset holder yourself and figure out the best, most appropriate method of doing that. Now, the people who do it the best, or at least in the highest level of acquiring wealth, have done it with property ownership. Now, understanding that mortgages is like the least interest rate that you are going to use in order to leverage yourself into an asset that is cash flowing, that's going to pay that asset back. That's a very unique position, and most people who understand it well, do very well at it. So again, borrowing money to buy a rental property is probably the number one way of acquiring massive amounts of wealth if you know how to do it right. And that's how every rich person I know does it. But it doesn't necessarily need to be done that way. Understanding that you need to move into an asset that moves up in value or pays you. The ones that pay you are the best ones. Businesses, dividend paying stocks, bonds, like there's a lot of stuff out there that will pay you. Figure out what it is that you need in your life that will pay you like that. This is how the asset allocation is done, piece by piece. The people who do it for a long period of time end up being on the top end of the wedge. People are like, well, how do I do it in a week? You can't. I don't know. Maybe some people can do it in a week. You can't do it in a week. That's a lottery ticket method, and I don't know if that's really possible. For some people, I guess it is. For other people, it's a dollar cost averaging over time to acquire what it is that you need in your life. Teaming up with other people so that you can get into those rental properties, figuring out how to house hack. This is the way that you do it. And there's no like magic formula to it. It's unique to you and how it is that it's happening. Cut back on your expenses, increase your cash flow, move into cash flowing assets. All right. All right. What jobs would you believe would be secure during a depression or worse? I really couldn't tell you what jobs are going. Like for me, I would think you want to be helpful and useful. Um, those are probably going to be like the best jobs. People always need something that's, done. So if you're helpful and useful and you have a good skill and one that is always in demand, if you could figure that out, like, people who are in healthcare are probably going to do quite well as the older population is going to demand healthcare. If you're not into healthcare, then maybe electrician, like an electrician kind of idea. Those sort of trades are kind of like common in the idea of it. But for me, like I I do things differently. Like I'm out there doing things in a whole different kind of fashion, right? And when I acquire like some money in my attempts of what it is I do, then I take that money and I pay my bills, but then I try to use that to position myself into some sort of asset that is going to be secure for the future, whether that's like a Bitcoin or silver or getting into stocks or making payments on the house or doing something of this nature. This is how I look at it. Now, everybody has to be unique in that fashion. Take your understanding of your position, where you're at, and what it is that you need for your future, and then be focused on what it is you're doing. Be disciplined on what it is you're doing. Okay? Like there's no magic secret to it. Cut back on your expenses and move into cash flowing assets. That's it. Yeah. All right. I'm a paramedic, started in 2007, pretty solid, right? Made a ton of put options this month, has made the year on the markets Thank you, MAGA Mayhem. Could see it from miles ahead. Yeah, see, that's another one. The put options, covered options, and calls. Scrap metal is a depression-proof job, and especially during wartime because they need the irreplaceable materials that make the weapons and the equipment. Ask me how I know. The best call is to go with the trend of the market, and right now it is predictable. Trend is downhill with Mega Mayhem. Easy money made a ton. Please capitalize. Huh. Grave digger. All right. The Fed, it continues to do what it needs to survive at our price. There is one Achilles heel to this nightmare: undersea cables, financial crisis, reset, and rats jump ship into the ocean. I don't know, like, is that an Achilles heel now? We got so much satellite technology now out there. It's not like it's impossible to transfer information around the globe. Now, granted, I would assume that the undersea cables are probably the most secure way of doing it and efficient way of doing it at this point, but it's not the only way of transferring information around the globe, right? So it's only a matter of time before the mother of, or the necessity being the mother of invention, that if this is going to be an Achilles heel, they'll figure out a way to get around it. All right. Scraps is 2 cents when I'm at, not worth the time, only saving money for the dump fees. Paramedics are pretty solid, but how long can they keep up with the pressure and the pain they see every day in this world? I can see where that would be an issue for a lot of people. The credible threat theory, it is a threat to new supply chains. We want to normalize the economy. Well, yeah, I know you want to normalize the economy. Like, you want that, Moses, but that's, I mean, unfortunate for monetary policy, that's not necessarily going to be the case. Right? Like, what we want and what we wish for and what we believe would be like an appropriate thing isn't exactly conducive to monetary policy or anything else out there. Right? Like, understanding the Cantillon effect means that there is a one-way direction that new money does to the economy of inequality, right? It creates that inequality. People who have first access to the new money want to enjoy it, get a raise, right? Win a lot or whatever. It's just like, if you get new money, what do you want to do with that new money? Now, some of us are kind of smart. And we're like, okay, we're going to take it and we're going to put it into our investments, our portfolios, whatever. Other people are going to be like, woohoo, time to go down to the bar, right? And so they're going to go and they're going to spend that money. That increase in that luxurious experience, that is the creation of the downfall. Moment that happens, the wedge of inequality is being created. The more the new money pours in, the more the wedge of inequality takes place. Now, we can say, let's force a situation in which that doesn't happen. That will look like a boot on the face of humanity forever, because there's no way you can stop it. People who have new money buy into luxurious experiences. It's just the way it works. And if they buy into luxurious experience, it's going to raise that standard of living. If they raise that standard of living, foreign competition is going to come in to compete with those high prices. The more foreign competition comes in, the more domestic manufacturers leave. You have to understand this cycle. This is the way it works. It's not like you can stop it. It's not like you can say, hey, man, can't we create a situation in which, let's go around and all imagine this artistic fantasy, this pure imagination scenario of how it is that an economy can continue to flood itself with new money and not separate the rich from the poor through luxurious experiences and driving the domestic manufacturers out. Like, let's sit around and imagine a magical experience where that could take place. It won't. It's artistic fantasies, pure imagination. Everybody who is out there trying to share information with you on how that can occur, this wonderful kumbaya experience that the politicians do the right thing, is literally feeding you a line of crap. And every single one of them says, the inflation is killing you. They're causing inflation. Warning, inflation, warning, right? Every single one of those is raising the neutral interest rate. It's making the asset holders that much richer, and they're probably one of them, right? And they're deploying that information into you so that they can make themselves rich, and you will feel the pain from it. If everyone is talking about inflation expectations and future prices being higher, will the recession even happen? Nope. I love how people talk about a recession and inflation at the same time. It's like, good one. Yeah, it's like that. Like that doesn't occur. That's not going to occur, right? If you have inflationary pressures, and the Federal Reserve sits still, you're gonna have the top 10, 20% of household incomes absolutely killing it, and they're gonna be doing so well here in the next year. You're probably gonna I would imagine that everybody's gonna be going like, "Wow, what a resilient economy considering everything that we experienced last year," just like they've been saying for the last 4 years. Because they don't understand what's happening with the elevated inflation and inflation expectation raising the damn neutral interest rate. We had this K-shaped economy as a result of it, and people are going, what's going on? I know. The politicians are doing this on purpose. I know. Right? Duh. And I'm thinking, oh, right? You're just feeding the power to the powers that be. Like, here, why don't we just wrap it up in a nice little bow and hand it over? And let me just hand you my wallet and everything else while I'm at it. You know? And I know that I'm the only one who's sharing information that way because I'm the only one who's broken down all these speeches in this fashion so that I could then deliver this understanding to you. Everybody else wants to just make themselves rich with it. And it's just if I wanted to make myself rich with this, I would be fear mongering and blasting the inflationary, Powell's causing you pain and suffering just like everybody else is doing who's making it rich on YouTube right now because that's the information they want spread. That's what Google is out spreading right now for everybody to see. I mean, think about it. We have hardly anybody here on this channel because the AI is that I now have essentially figured out is now using for my information on my video to then suppress it, saying, man, we can't have this stuff out there. Yeah. Go and push some real inflationary expectations out there that instead of the monetary policy and how that's being used, then maybe those videos would take off. That's literally what's coming down here. I mean, I bet you anything, if I was to just switch around and talk like, I don't know, anywhere and all the rest of them out there, then things would switch. Right? But if I break down this monetary policy for the reality of what it is, man, that algorithm hates it. Don't start sharing those speeches. Man, it'll recognize it. Start squashing that video. Never been easier time to make money. We got I take the longest time whiffing that, longer than taking a whiff off of the new fresh Chiba sack. Okay. All right. What gives a smell of the new money? You know that smell. When I got new money, I crinkle it up so it doesn't stick together. Hate new money when it sticks. Yeah. Sometimes it really sticks too. Money does grow on trees. Yeah, for some people I think it does. Trucker bot. If everyone is talking, we already read that one. No, we're not going to really have recessions like we used to, because recessions used to come from the working class failing to be able to consume. Now the working class doesn't matter if they consume, because you're not the consumer. If the top 10, 20% stopped consuming, then we might have a recession, but they're not. They're increasing their consumption. So back in the day, when the average everyday person started losing their job, that would create a recession because they would stop spending money. But now you lose your job and you stop spending money. It doesn't really matter. You don't spend that much. I mean, we feel like we spend that much, right? Because it takes everything we got in order to make it. But the actual consumption that's happening within the economy, we really don't participate that much inside of it. So when the consuming slows down from our side of things, it doesn't really impact the economy that much because most of the consumption is done at the top. So we don't really experience recessions like we used to. All right. All right. YouTube recommended you eat during the pandemic. They did good then. Yeah. Right. I mean, the pandemic was great for the uneducated economists. And of course, like, having been in the lumber industry and being able to call out lumber as well as I had, it was like perfect timing. Nowadays, this idea of the monetary policy is so esoteric. It is like I have to like literally educate people on understanding what it is that I'm about ready to tell them. All right. I mean, how many people have come to me, like I'll be standing there at the lumberyard, ringing up sales, and I'll have somebody come up and say something like, "Dude, what's going on within the economy?" And I'll have to look at them and say, like, "In what way?" Right? In what way are you talking about? Because there's so much going on in the economy, and if you want me to really answer what it is that I think is going on, you better understand what I'm talking about when I say the neutral interest rate. And if you got a glazed over look, then let's not even bother, right? Because we can't chit chat about the economy on this. It's going to get way too deep. I had a guy come up to me and he was just like, "Hey man, you want some oil? Look what he's doing to oil prices." And I was just like, "Okay, listen, bro. Let me tell you something. When you have an elevated inflation and inflation expectation, what you are going to do is you're going to raise that neutral interest rate and it's going to move ever closer to the Fed funds rate. What this is going to do, it's going to make the economy less restricted for the top 10, 20% of household incomes. So as you feel this hatred for the corporations and the banking system and all this inflationary scenario that you are feeling, and you feel the hate for it, and you want to spread that hate around, what you are actually doing is you are deploying power to the top 10, 20% of household incomes. Every single time you talk about it, you communicate it, and you express the pain and uncertainty and fear about what this inflation is going to do, you send that power to the top 10, 20% of household incomes. Now, when you think about it, does this do that? There's a different outcome that comes from this. Because now you're looking at the people and what it is that they're saying about the inflation and what that's going to do for the economy, because it's going to make it less restricted. And now you have to think about how it is that you position yourself in accordance for it, because yes, there is higher prices coming. Got that part. Okay. Now, what is it that people are thinking, feeling, behaving? And what's that going to do to the expectations, raising that neutral interest rate? And what is that going to do for the economy when it comes to the top 10, 20% of household incomes? Because this is the path of understanding that is going to give you a much better way of dealing with it. Right? People are like, "No, let's just make them pay their fair share." It's like, good luck with that. Adios, man. I'm out of here. I got other things to think about and do, because you're not going to be able to get them to pay their fair share. Like, that ain't going to happen. Yeah, I mean, go take your pitchforks and torches and all the other stuff and see if you can figure that out. Most likely it ain't going to happen. Now, we can understand what it is that's taken place so that we can position ourselves. We can know that the economy is going to become less restricted because of that elevated inflation expectation. We know that if there is an economy that is less restricted, what does that really mean for our investments? Does asset prices go up in a restricted economy, or do asset prices go up in an unrestricted economy? This is important to understand, because the expectations of the people themselves is the monetary policy. It is the top 1% that typically are not in your Walmarts. No, and I'm not talking, yeah, it's beyond Walmart. All right. UE, the Oracle of Aurora. Chuckerbud, man, this is great. I'm glad you guys are here tonight. 67 people who are watching, 63 likes. Thank you so much for hitting that like button. I love it when we have more people who have liked it than watching the video. And that's happening right now. So continue to hit that like button. If you haven't hit it yet, hit the thumbs up. We're going to continue to break this stuff down for a little bit longer here. I want to make sure that everybody understands what's going on, right? We have to internalize this in a fashion in which that the Federal Reserve has deployed the monetary policy. Like, we have to think about it in this fashion. Most people will never see it. In fact, most people are going to share thoughts and ideas that literally steer you away from this understanding. Like, literally guide you into another direction. In fact, the guiding that a lot of them are doing are literally guiding you right into the elevated inflation expectation scenario that delivers the power to the Fed. This is super important to understand. Right? That is ridiculous. Like to watch ratio. No, it's not. We got 74 people. Continue to hit the like button. With 74 people, we should have 74 likes. All right. Are you guys rounding up your pennies at the store? No, we still have pennies. We actually, the boss went and secured a bunch of pennies, so we still use pennies until we have completely changed all the prices in the store, which is taking place now. They're rounding everything, like all the prices are moving to the nickel, but we still have some that are, going off at 9 cents or whatever. And so we do have change that we are making at this point with pennies, but it is moving out. I, however, have been sifting through and pulling out all the coppers, because wherever he secured these pennies from, there was a lot of copper, a lot of wheat pennies left in there, and I'm getting all those out. Gresham's Law. Right. All right. When you have a situation of full employment, inflation usually is high. That is right, but it didn't exactly work anymore. And that was the breakdown of the Phillips curve. This is exactly right. This is so important to understand. This is why the Federal Reserve has now moved away from the idea of moving the unemployment around. There used to be an idea of a neutral employment rate, right? But the problem is that the unemployment rate, that neutral unemployment rate, or whatever you want to call it, was very low. And so at the Obama administration, at the end of it, all the way through the first Trump administration, there was historically low unemployment and no inflation. That's the breakdown of the Phillips curve. In fact, there's a whole speech that is great. If you want to go and read it, it's, hold on, let me bring it up. Here we go. It's called The Disconnect Between Inflation and Employment in the New Normal. So there's a whole speech. This is why you guys love watching The Uneducated Economist, because exactly comments just like that. Right? Now, I'm going to share with you on how it is that expectation of higher employment would raise the inflation. It doesn't work anymore. That broke down back in 2019. They had a whole realization. They were like, oh, shit. Right? All these people working all the way through from the Obama administration all the way through the Trump administration failed to produce an inflationary scenario. And now Ms. Lael Brainerd here in 2019 has an entire speech discussing that very thing, right? The Disconnect Between Inflation and Employment in the New Normal by Lael Brainerd, given May 16th of 2019, all right? It says the expansion will soon become the longest on record in the United States. Growth has persisted throughout the past decade, overcoming downdrafts from abroad and pullbacks in fiscal support earlier in the expansion and benefiting last year from the large fiscal boost. Recent data confirms that the consumer remains confident, workers are productive, and businesses are hiring, although trade conflict and creating uncertainty. The jobs market is strong. 3.6% unemployment rate is now lower than it was before the crisis. At 80%, the employment rate for workers in the prime working age years, a more comprehensive measure of slack that includes shift in the labor force participation as well as unemployment, has recently risen close to its pre-crisis level. Now, understanding this part right here is crucial. Here it comes. I mean, I know that kind of a little confusing. This is the critical information. In contrast, the picture on inflation is puzzling this far into expansion. Again, the contrast, the picture on inflation is puzzling this far into an expansion. Despite strengthening of the labor market, the measure of core inflation, excluding volatile food and energy prices, did not move up to 2% on a sustained basis until last year. This is 2019. We're talking quantitative easing started back in 2008? Or whatever it was back during the great financial crisis. This is years later. Still failed to produce an inflationary scenario, even though they had a tight jobs market. Here's the speech telling you about it. Right? With food and prices not moving up to the 2% on a sustained basis until late last year, and in most recent readings, the 12-month change has moved down to 1.6%. Other measures paint a somewhat more reassuring picture. The Dallas Fed trimmed mean measures of inflation, which provides a different way to filter out idiosyncrasies, movements in various components of inflation, has increased 2% in the 12 months, slightly higher than its level of 1.9% of the 2 previous years. There was no inflation. No inflation! The Fed should be printing money. Remember Trump saying that? You remember Donald Trump? He was all flipping out, Germany's doing it right by going into negative interest rates. Remember that was his first administration? Can you imagine? I mean, he did say that. You think about it. The Fed should be going into negative interest rates and printing money. That's what Donald Trump said. Crazy to think. But it was true. Like at the time, they couldn't find any inflation. They're like, man, what do we do here? We can't find no inflation. We're stuck here. All right. Goes on to say this. Because of this flattening Phillips curve, because the movement of the unemployment falling low, the tightening jobs market did not create the inflationary scenario, this is what Lael Brainerd had for a response to this. Of course, it is not entirely clear how to move underlying trend inflation smoothly to our target on a sustained basis in the presence of a very flat Phillips curve, right? So here she is. She was like, man, tight jobs market, barely made it to 2%. We don't know exactly. It's not clear on how to move underlying trend inflation smoothly. We don't know. How do we move it smoothly if everybody's working and it doesn't create an inflationary scenario? What do we do? One possibility might refer to as opportunistic reflation. What's that? Opportunistic reflation? You mean quantitative easing 1, 2, 3, and 4? Expansion of the balance sheet from 850 billion to 4.5 trillion wasn't opportunistic reflation? Like that wasn't an opportunistic reflationary moment? What in the hell would create an opportunistic reflationary moment if quantitative easing 1, 2, 3, and 4, which took the Fed's balance sheet of 850 billion to over $4.5 trillion, didn't produce an inflationary scenario? Like, holy crap, that didn't produce inflation? What would? What could possibly create an inflationary scenario, Ms. Brainerd? Opportunistic reflation would be to take advantage of a modest increase in actual inflation to demonstrate to the public our commitment to our inflation goal on a symmetric basis. You mean to allow inflation to run extra hot, extra long for an extended period of time on purpose? That seems weird. Opportunistic reflation, huh? Okay, what else does that mean? For example, suppose that an unexpected increase in core import price inflation drove overall inflation modestly above 2% for a couple of years. Whoa, Wait a minute. Did you say an unexpected increase in core import prices? An unexpected increase in core import prices. Unexpected increase in core import price inflation drove overall inflation modestly above 2% for a couple of years. The Federal Reserve could use that opportunity to communications, remember, that a mild overshooting of inflation is consistent with our goals. We're going to stick around till the job is done. Remember, the Fed is too late to raise interest rates. They let inflation get away from them. Inflation ran too hot too long. Remember all the stories of that? Remember all the people saying that? The Fed should have raised rates a long time ago. The interest rates are too low. The inflation is too hot. All those things were being pushed out there, communicated to the people out there. Opportunity to communicate that a mild overshooting of inflation is consistent with our goals to align the policy with that statement. Such an approach could help demonstrate to the public that the committee is serious about achieving a 2% inflation objective. Didn't you just say that you were looking for opportunistic reflation where you were going to let it run extra hot, extra long for an extended period of time and then back that up with saying our commitment to our 2% goal? Wow. Like, you really laid it out pretty clear on what it is that you were planning on doing, and here it is. Here it is. This is exactly what it looks like. Jerome Powell is deploying the information in which that elevates the inflation expectation, raises the neutral interest rate, makes the economy far less restricted, and they are committed to their 2% goal. All right, UE the GOAT. Well, thank you guys. I really appreciate it. 75 people watching, 77 likes. Go out there and share this video with everybody you know. We all need to understand what it is that's happening with the inflation expectation, raising the neutral interest rate. There's nobody else who's going to share it with you and share how it is that this is being used to conduct monetary policy. Some people may need to go back and watch the first half of this video a few times to get it. We're breaking it down constantly for you. All right. This is the only way to do it. Rehashing this information over and over again, going back through the documents that they have put out there for everybody to go and research, but nobody really did. All right. The other central bankers heard it, and they did not correct the situation when people had the misunderstanding of what it was that was happening out there. They used that misunderstanding against the people themselves. Inflation is going to be a painful experience. They know, all right? They know it. They know it was going to be a painful experience. In fact, Jerome Powell said it was going to be a painful experience. He said it in New Economic Challenges in the Fed's Monetary Policy Review, given August 27th of 2020. He said, the persistent undershoot of inflation from our 2% long-run objective is a cause for concern. I'm sorry, did you say that you were failing to achieve a 2% target over the previous decade, even though you had all this quantitative easing? That's right. That's what Jerome Powell is saying. The persistent undershoot of inflation from our 2% long-run objective is a cause for concern. Many find it counterintuitive that the Fed would want to push up inflation. No, those of us who read Lael Brainerd's speech knew that you were looking for opportunistic reflation, so it doesn't seem counterintuitive that you would want to push up inflation. It seems very much in line with what it is that you were facing for your problems of a persistently low inflation and inflationary scenario. So no, it doesn't seem counterintuitive that you would want to push up inflation because we follow Lael Brainerd's speech and John Williams' speech and everything else that has led up to this speech, which means that you need inflation and inflation expectation desperately to save your monetary policy. Let's continue reading so you can admit for it yourself. After all, low and stable inflation is essential for a well-functioning economy, and we are certainly mindful that higher prices for essential items such as food and gasoline and shelter add to the burdens faced by many families. They know you're going to face this burden. They know it was going to be a painful experience. They know the inflation hurts you. They know it, right? Such as, like, again, we are certainly mindful that higher prices for essential items such as food, gasoline, and shelter add to the burdens faced by many families, especially those struggling with lost jobs and income. You're going to face it the worst, not the rich elitist. You're especially going to face it if you lost your job and you have loss of income. And if there's an inflationary scenario, that's your loss of income. Unless you have increased your income, you lose your income because of the inflation. Jerome Powell was telling you this was about ready to take place. They knew it was painful. They knew it was going to happen. However, inflation that is persistently too low poses serious risk to the economy. I'm sorry, pose a serious risk to who? I mean, because inflation poses a serious risk to a group of people, but the lack of inflation poses a serious risk to the economy. Who exactly economy are you talking about, Jerome Powell? Right? Like, here it is. You know that the inflation is going to be, you're mindful. You're even mindful of it. You know, we got that in mind, that this inflation is going to be a painful experience for people at the end of the line. However, it poses serious risk to the economy. Whose economy, Jerome? The rich elitist economy? Is that the economy you're talking about? However, inflation that is persistently too low can pose serious risk to the economy. Inflation that runs below its desired level can lead to an unwelcome fall in long-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. Does it sound like the Federal Reserve was desperate for inflation and inflation expectations to be elevated, mindful that it was going to be a painful experience for you so that they could save the economy? Whose economy? Well, who's kicking ass right now? Go and type in any article about the K-shaped economy and then tell me who it is that's kicking ass right now, considering what it is that Jerome Powell was saying in this speech. Okay. Why would you pull the engine for a head gasket? Okay. Giving up on investing, it's just been a kangaroo for so long. Is the expectation to keep putting money into the market or physical payoff, house, etc.? I'm doing stock market, I'm doing real estate, I'm doing gold, silver, Bitcoin, and I'm figuring out what it is that I need to do to increase my cash flow and cut back on my expenses. All the charts and measurements point to 2008 except for one, employment. Do you think we'll never see that? I have no idea what it is that people anticipate happening as far as like the 2008 scenario, but nothing that I see even remotely comes close to what was taking place in 2008. Nothing. Nothing I see comes even remotely close to what was taking place in 2008. Some people want to say, oh, dude, it's way worse than that. And in a lot of ways it is, especially with the debt issuance. But what we were facing in 2008 is not even close to what it is that we have going on with our monetary policy today. All right. In 2008, the Federal Reserve was about ready to run out of monetary policy and deploy forward guidance. They had a situation in which that the mortgage market was completely filled with toxic assets. Now, there are toxic assets out there, but it's not in the mortgage market. Not like it was. There was people out there who got mortgages, got houses that were never, ever, 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 ever going to pay those mortgages off. They were destined to fail. It was only a matter of time. That situation doesn't exist in the mortgage market like it did. There are a lot going on out there that would then give you the belief that there is going to be a crisis situation like that of 2008. The one thing we have to remember is that when the recession kicked in and the job losses really ramped up, it sent the economy into a spiral. Financial crisis like you wouldn't believe. Now, to understand the situation that we were facing back then was full of toxic assets and no real way of understanding how it is that the Federal Reserve was going to deal with the situation. People lost their mind. When the Federal Reserve fired up quantitative easing, the people went nuts. I was one of them, right? I lost my nugget over it. I said, holy moly, look how much money they're printing up. This is going to destroy the purchasing power of the dollar like you wouldn't believe. This is quantitative easing 1. Then they did quantitative easing 2 and 3 and 4, and they ran consistently at the lower bound of 0, and I dumped every dime I had into silver, believing that the dollar was done. It was cooked. There's no way it could possibly survive any of this. But then they didn't even have an inflationary scenario that hit 2%. Right? All my idea of what was happening within the economy and the failure of the dollar never really actually manifested itself. And by the end of 2018, I'm reading speeches from the Federal Reserve talking about how they were desperate for inflation. And I'm thinking, what the hell did I get wrong? How did I get this so damn wrong? I dumped all my money into silver believing that the dollar was going to fail. I had committed myself to that outcome. I had nothing left. I lost my house, right? I could have, there was other reasons for that, but it doesn't matter. Right? I went through a foreclosure. I had all these issues taking place. I had to look back and say, man, what did I get wrong about the Federal Reserve and the money printer? And then I realized what it was that the Federal Reserve was facing. They were facing a low neutral interest rate. They were operating at the lower bound of 0. Fed funds rate were at the lower bound of 0. This is a completely different situation that was happening back during the great financial crisis than is taking place today. Today, we have an elevated inflation expectation. There was no elevated inflation. There wasn't even actual inflation. Not only was there no elevated inflation expectation, there was no elevated inflation anyway. That is not taking place like it was. That was not taking place back then. Today, we have much elevated inflation expectation. Totally different game now that is being played, because now the neutral interest rate is much higher and the economy is far less restricted with an elevated Fed funds rate than anybody would have given it consideration for. And this is why I keep sharing this information over and over again, because what Powell did today with his speech is literally ease economic conditions. People won't recognize it until later because it takes time for it to actually show up in the economy, but people here are going to figure it out in the future. They say, man, what's going on with the resilient consumer, this resilient economy? It just seems to be chugging along. How many times have you heard this over and over again? Because that elevated inflation expectation based off of COVID, based off of war, based off of tariffs, based off of Fed independence, all this stuff pushes that neutral interest rate higher, and it makes the economy far less restricted for the top 10, 20% of households. But the 80% of the people are, why? Why does it not work for us? Because we are trying to spend time trading for dollars and it doesn't work. You have to be an asset holder to see it. If you are not an asset holder, you won't see it. If you are buying a house, you probably see it. If you are loaded up on gold and silver, you probably see it pretty well. If you were sitting in the stock market for all these years, you probably see it pretty well. But if you're trading your time to try and make a living, you are suffering the consequences. That's why there's two-tiered economy happening: asset holders and people who trade their time. That's it. All right. The hodl bras love the air coins. UE, right again. Thank you, Nick. Righty. The markets are your insurance policy. You know how to day trade, make money. There's no need to gold, silver, etc. money at your fingertips. All right. Yes, trade stock too. Nice. The trick is to gotta hodl. Does elevated expectations always equal inflation, or can we get no inflation even with high expectations? Yeah, I mean, think about it. Quantitative easing 1, 2, 3, and 4 had elevated inflation expectations that ran incredibly high. Right? Like how many people, like you should have seen it. It was just unreal. Hyperinflation scenario right around the corner. But it barely produced the inflationary scenario that they were looking for. You know why? It's because inflation is more of a severing of the supply chain. If you sever the supply chain, guaranteed inflation. Threatened to sever the supply chain with credible threats of tariffs, war, whatever, right? COVID, shutdowns. This is what creates the inflation. Money printer go burr, like yeah, maybe a little bit. You can get some inflation expectation out of it that might raise it a little bit. But all that money printing back in the great financial crisis, taking the Fed's balance sheet of 850 billion to over 4.5 trillion, failed to produce an inflationary scenario. It just stayed locked up in the banking system. So unless that money is lent or spent into the system, it doesn't chase the goods and services. Severing of the supply chain and handing out stimulus packages definitely created an inflationary scenario. And if you can keep the supply chain broken, then you can keep that inflationary scenario moving. If you were to just hand out the stimulus packages, it would have been a flash in the pan scenario and it would have been quickly over. Because unless the new money is constantly pouring in to create the inflationary scenario, it's going to be a one-time event. But if you keep the supply chain broken, credible threats of war, credible threats of tariffs, credible threats of Fed independence, well, maybe not the Fed independence on the supply side of things, but you never know on what it is that the story is being told at the time that could create that inflationary scenario. Right? Because expectations is one thing, but the severing of the supply chain is a real event. And that severing of the supply chain definitely created an inflationary scenario. Alrighty, guys, are we going to call it quits? Oh, we got to go check out the super chat real quick. All right, you either go. Thank you, Nick, and thank you so much for the $9.99. I really appreciate the support. All right, if Powell changed the interest rate either way, everyone would have ran with it. Keeping it the same was the right move. UE has proven track record. That's why I trust him, not some grifter. Well, thank you, Nick. I really appreciate it. And yeah, I mean, I would like to think that my track record is pretty good about this. You know? I mean, I even did a video, what was it, not too long ago. Well, actually, it was years ago. I think it was called "The Fed is Going to Keep Supply Chain Broken." Like, let me look that up. Let me see if I can find that. I'm pretty sure I did one that said that. Oh, keeping the supply chain broken. The Fed wants to keep the supply chain broken. Boom, 3 years ago. Right? Let's hear what I have. Let's review. And I don't even know. Like I knew I made this video. I don't remember what's in it. Let's review this video real quick and to see what it has to say. I've done so many videos covering every single topic, you know? All right, I got to get to these commercials because these damn YouTubers, they all need to make all this money. Okay. And how they are going. Okay, let's try this. Oh, what? Now you're not going to work? Good afternoon, everybody. Uneducated Economist here. So I'm just going to do a brief video here. I just wanted to share this article with you guys. It's a CNBC article talking with Fed President Evans, and it's pretty much the same typical thing that we're hearing coming from the Federal Reserve. and how they are going to be fighting this inflation with higher interest rates, but now have become concerned that they may be pushing it too far too fast, right? Even Evans is coming out and saying this. Now, Evans has always been a very dovish kind of president who is much more into the money policy, so it's no surprise that you would hear Evans have this sort of statement coming, with all the conditions of the economy right now. Because right now we have a lot of people who are very concerned about recession. I mean, you see so many articles out there that are pretty much talking about not if recession hits, and that there is no way that we're going to avoid a recession or have any kind of soft landing. I mean, that kind of stuff is all out the window. Now, what I found interesting about this article after I read it, because it's not a surprise to hear the Federal Reserve say that they are fearing that they are not going to be able to bring this inflation down, at least in a way that doesn't completely destroy the economy. I don't know if I'm saying that right, but anyway, pushing the rates too far too fast. Here's the thing. Listen to what they are saying. There is a lag. This is what the biggest concern I feel is coming from the Federal Reserve, and how they may not know exactly where to be, because this is true to think. Like, once you have lifted the interest rates, it takes 6 months to a year before that starts to affect the economy. So right now, we are just now starting to feel the effects of the very first lifting of interest rates that the Federal Reserve had done. Think about that. We are just now starting to feel the real effects from the very first lifting of interest rates. That means we have all these other lifting of interest rates that have already taken place. Said lifting, I meant rising, right? Rising of interest rates.
So
what the argument is now saying is that we don't know how much is too much until we get a feeling for what these lifting of interest rates has done. Right? Does that make sense? Because right now we have the markets who have already, done their thing off the information and everything that's come out. Like, the markets have already positioned themselves. But the real economy, the decisions that we make, the future projects that are coming in, all those transactions that are supposed to be taking place, and whether or not you have confidence that this economy is going to do well. This is really where the real economy starts to behave from these lifting of interest rates. If you lift the interest rates, it becomes restrictive. People get very fearful of, downturn in asset prices. They don't want to spend money. They don't want to spend that money as freely. They start losing the wealth effect, which is what happens when asset prices go up. You see the house prices go up. You see the stock prices go up. You see all these things go up, and you think, oh, wow, look at all this money I've made, right? Even though you haven't sold anything or actually have the money, just the idea that the prices have gone up as much as they have gives you this feeling that you have this wealth. And then you go out and start spending that into the economy. Well, the exact opposite happens when you have a downturn in the economy, or at least in the markets like we are seeing right now, especially when the markets are behaving off this information, because the real interest rates, or not the real interest rates, the interest rates haven't affected the real economy yet. They're just now starting to. So all this stuff you have to take into consideration. Now, go and read this article, right? I'll leave a link down in the description for you guys. Go and look at the very last paragraph of this article and look at what Evans said, that he was hoping that they would get more relief on the supply side of things. And I laugh at this. I so laugh at this, because when they made this statement months ago, like when they said, okay, we're going to get rid of the mandates, we're going to start, dealing with this inflation, we're going to start raising interest rates, we're going to unwind the balance sheet. They started making all these statements out there to try and condition the markets to get ready for the lifting of interest rates, to be in a more constrictive economy, right? And now, what did I say back then? I said, how is this going to happen? How is it that you are going to bring an inflation scenario down with the help of the by lifting of interest rates? Like, that does not make sense to me. Because if you are working the supply side of things, if you are a distributor, a retailer, a wholesaler, whatever, you're working on that supply side of things. And now what the Federal Reserve wants is for you to start doing your job more. They want you to invest. They want you to start working harder, try to get that supply moving through the system more efficiently.
With Robinhood Gold, you can instantly start earning 3.35%.
Oh, give me 1 second here, guys. That's what they're hoping for. But yet at the same time, they are going to lift interest rates, which one is going to make it harder for you to invest, right? To borrow money to invest into your company. And then two, that's going to kill the consumer, the person that you're going to rely on to buy the products that you're trying to get through the distribution network. So the Federal Reserve is looking for help from the supply side of things, at the exact same time doing things to be very cumbersome for the supply side to fix. Does you see where I'm kind of getting at here? Like if you were going to try and damage the consumer from going out there and making purchases to try and get the inflation to come down, right? Because you don't want them working as hard. And then say we want help from the supply side of things, meaning that you want the supply to start flowing through the economy. And you're going to lift interest rates, making it a burden on them. So how is that going to work? I mean, that's where, like, if people say the Fed has lost control, if that is a real game plan, like if that is really the strategy that they're using to try and bring inflation down, it's going to fail. I mean, I said it was going to fail months ago, and now here we are, and Evans is scratching his head going, I thought we would have gotten more help from the supply side of things. I wonder why we didn't. Well, maybe we should watch Uneducated Economist, because he said it wasn't going to work anyway, right? I mean, I'm not trying to brag it up saying that, you know, I'm smarter than the Federal Reserve, but when the Fed said that this was what they were going to do, I said it wasn't going to work then. And that wasn't what their real plan is. They want to keep the inflation scenario going. They want to keep the inflation expectation running hot. Now, I don't care what anybody else says out there. This is what they had asked for prior to the COVID restrictions, lockdowns, all that stuff. Tell me, man, this is a 3-year-old video. Like, I made this video 3 years ago, all right? Like, I don't change my tune. Like, I mean, I might as well made this video last night. I mean, I bring it up all the time. John Williams' speech, Monetary Policy for a Low Neutral Interest Rate World. Just Google that. Go and look at it and go and read that. I'll go and get the speech. I'll leave a link down in the description for you guys. Go and read the speech. Look at what he said. The Federal Reserve is facing a much bigger problem of inflation expectation that is running persistently too low rather than too high. That is exactly what he was saying inside of that speech. Well, right now, they have an inflation expectation that's running high, and they are loving it. They are getting those interest rates to move up, the Fed funds rate up to that 5%, which is really where they would want to be. I mean, to be honest with you, I'm surprised they were able to get it past this 2.5%, but they're doing it so fast that they're not able to impact the economy as of yet. Once they do, they're going to have to immediately reverse course and buy a lot too. So, but this is the part. This is the part that I really got wrong about the Federal Reserve and the interest rate adjustments, is that I said they weren't going to get 2.5%, but I wasn't thinking exactly clearly on what it was that I was trying to communicate there. Is because I didn't think that they were going to get a 2.5% restriction upon the economy. Now, at the time, I wasn't thinking about inflation pulling the neutral interest rate higher. That was still I was still forming that idea. You got to think, this is 3 years ago, and I was still trying to kind of understand what was happening with monetary policy at the time. So this is one of the things that I did get wrong, and I would admit to that I didn't think that the Federal Reserve was going to get much above that 2.5%. But then again, I wasn't thinking about the neutral interest rate rising up with the inflationary scenario, which totally made sense to me. I was just stuck on R star being at the lower bound of zero. Does that kind of make sense? That's the reason, like, even then, I remember this. Like, at the time, I remember thinking, man, how is it that the Federal Reserve is going to get above 2.5%? I just don't believe that they can. What I should have said is they're not going to get 2.5% above neutral, which, if you put the inflationary scenario on top of R star, puts the neutral interest rate much higher. Right. And then the Federal Reserve can be on top of that, which put them up over 5.5, or, you know, and then if the inflationary scenario keeps going, it can go even higher than that. So that was the only thing that I really definitely called out. Man, I got that prediction wrong. And then I understood why I got it wrong. And I think my explanation of my new understanding of why I got it wrong is a very good, clear understanding and a better understanding of why. Anyway, let's move on. As they're going to be able to get past that neutral rate of 2.5% on the Fed funds, where they're neither restrictive nor accommodating, and they're going to be able to go past that all the way up to that 5%, which is where they really want to be. Well, maybe I did explain it here. Hold on, let me back it up. Maybe I did explain it. in this
not
video.
able to impact the economy as of yet. Once they do, they're going to have to immediately reverse course and buy a lot too. But because they're moving it as fast as they are, they're going to be able to get past that neutral rate of 2.5% on the Fed funds, where they're neither restrictive nor accommodating. And they're going to be able to go past that all the way up to that 5%, which is where they really want to be, because if they hit a recession.
Wow, I called that out too. Like, I mean, I said 5%, it was a little above that, but still, that was pretty good, right?
They're going to want to drop that Fed funds rate around 5% to stimulate the economy. And there's no way they can do it, get that interest rate up to 5% on the Fed funds level without completely destroying the economy. So this is how they were able to do it. They got the inflation expectation running extra hot, extra long for an extended period of time, and then promised the people that they were going to battle it with the lifting of interest rates. They need to do it incredibly fast so that the economy doesn't catch up to the fact that they have lifted interest rates too far. And then once they have it up to that 5%, people are going to be like, oh crap, you've tightened up too much. You're causing undue or unnecessary pain. Everybody is crying about it. And the Fed says, no problem. We're going to stimulate the economy. Just watch us dropping the Fed funds rate back down to from 5% back down to 0. They have the 5% drop in interest rates that they were looking for in order to stimulate the economy, and everybody gets to be happy again with the easy money flowing policies.
So, I mean, I think I got some of that right. Like, I mean, that was a little, like, I mean, I think that really now that they have the interest rates elevated, they do have the ability to lower interest rates back down to 0. But I don't think that's much of an effect on stimulating the economy anymore. If they had it at 5%, and the inflationary scenario was also running rampant, which pulled the neutral interest rate up to around 5%, then lowering interest rates to 0, I think would be stimulating to the economy. But you have to have that inflation on top of it. So my understanding has evolved quite a bit, even from this video. But still, the video is titled, "The Fed Wants to Keep the Supply Chain Broken." Right? That I still believe today. Right? So there's some stuff in this video, this 3-year-old video that I had done, that I didn't exactly get accurate, but there's a lot of stuff that I really did. And even titling the video, "The Fed Wants to Keep the Supply Chain Broken," I think is very accurate to even today. Like, you know, just think about it. They're loving the fact that the inflationary scenario is going to be running rampant through the economy, especially with the deployment of the communication that they did today. You know? All righty, 92 likes. Thank you so much. Put Simon, you said they can't stimulate the economy unless they drop it all the way down to 0, neutral interest rate around 2. At the time, right, I was at the time I was thinking of the Fed funds rate being at 5% and then them dropping it from there. Right? So at the 5% level, you would have to have inflation also running it up at 5%, right? In order to have, you know, to get far enough below neutral on that 2%, that's going to need to have the inflationary scenario also running in order to pull that in order to pull that neutral interest rate up enough. At the time, I didn't get that accurate. I'm trying to admit that. What I'm trying to explain now is how that has occurred. Like, that inflationary scenario has pulled that neutral interest rate higher. If it pulled it even higher today, you could get it to the point that it would be up above that 5%, and the Federal Reserve could lower interest rates and actually stimulate the economy with the lowering of rates. But the only way to do that is to have that inflationary scenario elevated with the neutral interest rate being elevated as well. There is no reason in the world the Federal Reserve would do that. So the lowering of interest rates is not an effective tool. It doesn't work anymore. Right? At the time, I believed it could. I do not believe that today. All right. They have to lower interest rates to refinance the debt. They will lower interest rates, Simon. Well, good luck with that. All right. Becoming the world reserve currency nation was a curse, and it wasn't even really our choice to do it. Like, we did by a lot of bankers' choice and stuff, but us, the people, really didn't make that decision. Now, we did decide to voluntarily use the Federal Reserve notes. We didn't have to. We could have rejected them. We chose to use them. That's our fault. Becoming the world reserve. Oh, we read that one. The debt might be easier to get rid of if you move to a financial system that's capable of 100 times more transaction per minute. No, won't make any difference. Forget that YouTube starts live videos from the beginning now. Had to skip forward. Hey, do you think the top 20% can continue? Well, if the new money pours in. If you have ever increasing amounts of debt issuance, then you are going to have ever increasing amounts of new money pouring into the top, and they're going to continue off operations. The moment that the new money turns off, the moment that the debt issuance turns off, that's when it starts to collapse. So can they continue? Yeah, of course they will. Right? Alrighty. Cool. Did you guys have fun? Was this a good video? We got an hour and a half into it. I think it's really important, some of the stuff that we had covered today, especially understanding the monetary policy from the credible threat theory. There's very few people out there who are going to be from the understanding of the Federal Reserve's own words, like we have broken down. When you raise that inflation expectation, you will raise that neutral interest rate and the economy will become less restricted. But it's not less restricted for us. I mean, it is in a way, but it doesn't really benefit us that much. It really benefits the wealthy. And so when I think about all the inflation warning that you get from all the rich elitists out there who are so concerned about the working class individual, just think about the pain that you experience from inflation that they are trying to express to you, how painful of an experience you're getting from this and the reasons why you're getting this pain, and think about how it is that that's benefiting them every time they deploy that information into you. Right? If you can recognize it, you can understand that this is inflation and it's hurtful and it's painful and all that other stuff. Great. Got that part. That's a lot of pain. Now, how is it that this is really benefiting the economy, benefiting the monetary policy, and especially benefiting the top 10, 20% of household incomes? Because they're the ones who are doing it. All right. Okay. You guys are awesome. Thank you so much for being here. We got awesome. Glad I got to catch this live. Well, I'm glad you're here too. Sorry, I can't hit like only. I can hit like only once. Well, I appreciate you hitting the like. Thank you, UE. All right, you guys are awesome. Thank you so much for being here. Blockchain reduces the time between debt cycles by at least half quicker. Yeah, but okay, so it's not necessarily the amount of transaction time that's the problem. The problem is that we have ever increasing amounts of new money that is poured into the system, and the people who had first access to that money, they actually enjoyed it. Now, the problem with enjoying that new money is that it caused a situation in which that the domestic manufacturers in our area, the United States, have been moving out, and the foreign production is moving in. So when domestic manufacturers are moving out and foreign production is moving in, even though you have faster transactions, you are not producing real goods and services. All the creative financing in the world doesn't produce real goods and services. Faster transactions don't produce real goods and services. When the new money turns off, you don't produce real goods and services, you die. I don't care how fast you do the transactions if you can't produce real goods and services. Okay? And because we have ever increasing amounts of new money, we have pushed all our production of goods and services, well, goods anyway, out of the nation. So, yeah, that's a problem. And again, it doesn't matter how fast you can do the transactions. It doesn't matter how creative you are with the financing of it. You got to produce the goods and services so that you can trade for the items out there that you want, all right? If you don't have the ability to produce real goods and services, you have to rely on somebody's or borrowing the money from somebody else. This is the case for the United States. All the creative financing in the world doesn't save the situation. You can cycle the new money out at a rate that's double. Oh, okay. Let's continue our journey. See if we can get the 20%. I'm sorry, I didn't mean to ignore that comment. Let me go back in there real quick. You can cycle the new money out at a rate that's double than what you were capable before. Yes, you don't produce new goods. You tokenize. Real goods and services, countries, good investments. Yeah. Ascribe digital value to physical items and just fake items like NFTs and stuff like that. No, it's not going to work. You have to be able to produce real goods and services, and then you can, trade that for whatever currency. Currency is nothing more than that. It's meant to trade goods and services for other goods and services. So you have to be able to produce real goods and services. That's it, right? Then the creativity of how it is that you exchange those with other people, that's where all the tokenization and debt and all that other stuff comes in. Okay, you guys are awesome. I would love to sit here and keep reading comments, but I'm going to go eat because I'm hungry, and you guys are awesome. Uneducated economist, you let me know.